Welcome, everyone, to our session on the private equity approach to investing in Asia. Now, we're privileged to be speaking with Weijian and Shan, Chairman and CEO of PAG. Thank you for taking the time, Mr. Shan.
Now, thank you very much for having me, Michelle.
Yeah, so PAG is a diversified alternative investment management company with 40 billion in assets under management across strategies that include private equity, real estate, and private credit. Now, our speaker today, Mr. Shan, is an economist and the author of two recently published books. The first one, Out of the Gobi, a memoir, and Money Games, which is a new book on the buyout and turnaround of what was once the largest bank in Korea, a deal that was led by Mr. Chan for Newbridge Capital. Newbridge was later renamed TPG Asia. So I'd like to begin by talking a bit about your experience, Mr. Shan, in the private equity industry over the past 3 decades or more. Now, we've had a number of crises in that time, the Asian financial crisis, the GFC, among others. No? What have you been able to draw from your earlier years to navigate through this current crisis?
Well, first of all, thank you very much for having me. Yes, I have been in private equity for more than 20 years and have been through some ups and downs. In my experience, every crisis, of course, brought some headache, but every crisis also brought some opportunities. Our best deals tend to be done during the crisis time. In my new book, Money Games, the inside story of how American deal makers saved Korea's most iconic bank, is a story of a deal which I led during a financial crisis to acquire what used to be the largest bank in Korea. So crisis presents opportunities, and therefore, in times like this, we're extremely alert. First of all, to make sure that the portfolio companies in which we have invested would survive the crisis, which means that we need to manage its cash flow, its debt level, and its business, and so forth. But at the same time, we're not scared by the crisis. We open our eyes and look for opportunities to make investments. And if you structure deals right, if you look at the right business, this is probably as good time to make investments as any other, because the market is so down, especially in the private market, if not in the public market.
So what are the opportunities that you now see? I mean, if these indeed are the best of times. In fact, PAG has been comparatively active this year, no? Even as other investors have largely kept to the sidelines.
Yes, we have. PAG has 3 businesses. We have real estate investment, we have absolute return, which includes credit fund, special situation, and hedge fund. Then we have private equity, buyout, and growth. I'm chairman and CEO of the group, but I focus almost all my time on the private equity side, especially on the buyout side. Last year on private equity, we deployed about $2 billion. And this year, even 3 months ago, I thought we would invest about $1 billion because we thought the market was slow. Doing deals is difficult given the lockdown situation in so many different countries. But looking at our pipeline today, it seems we're going to invest as much this year as we did last year, and that is about $2 billion. So we have been very active, very busy this year. You see, some sectors are very much impacted and maybe permanently impaired this year because of the pandemic, because of the lockdown. For example, almost anything related to hospitality is very much impacted. Hotels, airlines, restaurants, retail shops, entertainment, and so forth. So you have to be very careful to determine which ones will be able to survive and thrive in the future. But at the same time, you find that some other businesses are doing extremely well this year. For example, e-commerce. We're the second largest shareholder of Tencent Music Entertainment. And this year, revenue and profit are both up. And we're also the largest shareholder of what is the largest dairy farm business in China. And this year, again, revenue is up and EBITDA is up very substantially, I suppose, because people think that milk can really help with your immune system. That's our guess. We don't know for sure. Suffice it to say that the business is up quite substantially. So in general, I think if you look at the entire market, you find some businesses struggling, especially those which are heavily indebted. But you would find some bright spots, as I just mentioned. So we look for those opportunities which probably will have much large potential in the future. But in different markets, our strategies are very different. In China, we tend to invest in businesses which cater to private consumption, and we stay away from exports. And in India, we do the opposite. We tend to look at firms which do outsourcing and exports. And the reason is, in China, labor cost and currency has been appreciating very sharply in the past 10 years, making costs of input going up every year, whereas the prices for finished products have remained either flat or even falling. So in China, for the export sector, profit margin is squeezed thinner every year, and that's why we stay away from it. In India, rupee is rather weak, and this year RMB has appreciated about 6%, rupee has depreciated about 4%. In such an environment where interest rate is also very high, hedging is difficult, you tend to invest in businesses which do outsourcing because they receive hard currency, US dollars or euro, as income, and their cost is in rupee. So if there's a devaluation, you actually benefit from it. So you have to understand the macroeconomic conditions in different countries in order to make the right decision, follow the right strategy in different markets.
But what about, in terms of impacted businesses, like you said earlier, I mean, would there be opportunity there for a buyout or and turnaround?
Yes, we just announced deal in Australia. I think the company's name is something called Rex. It's a regional airline business. It's a regional airline business. You would think that most people will stay away from airlines in this kind of market, but this is a little different because it's regional. It serves routes which are more or less exclusive in different internal destinations in Australia, which most people don't know is as big as 95% of the entire continental United States. So Australia is very big. There's big need for domestic flights. And if you have exclusive routes, then you know that sooner or later the business is going to rebound. So we have signed agreements, still subject to regulatory approval, to invest in that business. In India, we have signed 2 deals so far this year, one in wealth management business called Edelweiss Wealth Management, which caters to affluent consumers who need to manage their assets. And the other is a drug company. We think that India is particularly suitable for making pharmaceutical products. So again, in different markets, you see different opportunities, and even in the crisis, you find that some opportunities shine through. I'm sorry.
So, I mean, what will it take though? What about Southeast Asia? I mean, you've talked about India and China and Australia, but are there opportunities in Southeast Asia?
We have done deals in Southeast Asia. We have an office in Singapore. We have been very active in different markets in Southeast Asia. Of course, Southeast Asia is very big. I think with the signing of regional comprehensive economic partnership, Southeast Asia has become even more attractive. For a buyout firm like ourselves, it's not so easy to find good buyout opportunities in Southeast Asia because we invest no less than a few $100 million per deal. And therefore, we need the business to be of significant scale. In large markets, it's easy to find business of very large scale. In Southeast Asia, it's more difficult. So, but from time to time, you will come across very interesting opportunities, and we are very busy looking for them.
So coming back to dealing with times of crisis, I'm just wondering whether the pandemic, as well as its consequences, has also sort of triggered or meant to rethink of some parts of the investment process, in terms of some of the considerations or the lens that you would employ now that perhaps weren't so in place before when evaluating assets.
Well, typically, you're talking about investment, new investment, as opposed to portfolio management. Which one are you talking about?
New investments.
New investment. I don't think that the way you look at deals will be different, whether in crisis or in normal times. I think the only difference is that very often in the crisis, the sell side is in more need of capital or in some kind of a distress situation. You really have to understand the business, understand the industry. You have the knowledge and the experience in order to make the call that this is the right business to invest in. But you would underwrite deals, I would think, in the same way in the crisis as in normal times. You need to be disciplined on valuation. You need to look for businesses which have some uniqueness to it, that is competitive advantage, whether it's technology, market share, or license, something that prevents competition from eroding its profitability. And I think from our point of view, especially in the buyout business, another very important condition is that the business will have to be scalable. That is, it's not good enough that it is profitable. You want to make sure that there's enough room and potential for growth. And that is why to be able to scale is very important for a business for us to invest in. For example, in a large market like China and like Japan, you will be able to scale up business because the market is so big, right? Tencent Music Entertainment, we have 800 million monthly active users. Where else on earth do you find 800 million users for one business? America has scale, and Japan, to some extent, has scale. The same business model, if taken to, let's say, Hong Kong, you wouldn't get anywhere because the population is just too small. So that's why we tend to look for unique businesses in markets where scale is possible.
I mean, you've spoken about these details that sort of give you an edge in this environment, but I also wanted to understand in terms of there's also competition for talent. Family offices, pension funds are all out to hire people to do direct deals themselves. Where does this leave PE funds such as yourself? How do you build a team for the future, as it were?
I think you're absolutely right. In private equity business, it's all about talents. If you have the right people, you're successful. If you can't build a good team, you won't be very successful. From our point of view, PAG is somewhat unique in its culture in that everybody feels like an owner. We do an annual review of everyone, and we evaluate or review professionals on a number of attributes. And the first attribute we review a person is sense of ownership. And if you have a sense of ownership, then you will do things very well. The question is, how do you foster a sense of ownership? There are many ways of doing that. Of course, in private equity, we have an incentive system which ties your performance with your compensation. That's part of it. But an important part of it is to be able to participate in decision-making process. We are almost unique in that in our investment committee, everybody has a veto, and nobody has the right, including myself, to push through a deal. And anybody else can veto it. So every decision is made on unanimous basis. And that means everybody will have to participate. Everybody will have to express his or her views. And if anything goes wrong after making the investment, we don't blame each other. We don't point fingers because all of us were involved in decision-making process. So to the extent you participate, you own the deal. And that sense of ownership, I think, is very important. It's like a glue that keeps the team together and keeps your talents together. I think that's probably something we are quite unique and special about.
It really does sound great. So do you already have your next generation of the team in place? I mean, the three of you founders have been at the helm for so long. I mean, what does the next generation of leadership look like?
Absolutely, absolutely. You see, our most recent buyout fund is $6 billion. Previous to that, it was $3.6 billion. And earlier to that, it was $2.5 billion. So we have grown over time. And this is all public information, so I don't mind talking about it. Usually we don't talk about things inside the firm. But for the $2.5 billion fund, for the $3.6 billion fund, I was the one traveling around to raise capital because I was more familiar with our LPs. And when we raised, by the end of 2018, our current fund of $6 billion, I didn't travel at all. It's all other partners who traveled and spoke with LPs. Of course, I met with LPs when they came to Hong Kong to conduct due diligence, because we wanted to show to LPs that we have very long runway. And we have the next generation of leaders who are a lot better than me.
Okay, that's great. So let's sort of switch gears a bit. I wanted to ask you about your views on the macro context of private equity in Asia. So, I mean, what are your observations about the developments in relations between the US and China, for example? I mean, what does a Biden administration mean for the investment outlook in Asia?
We are in between a transition period at this moment. There's an outgoing administration during which the US-China relationship got to a very low ebb in the past 40 years. We don't yet know what's going to happen with the new Biden administration, but I think enough analysis has been made to indicate that the new administration is more likely to go back to the consistency of Americans' foreign policy. And there is some consistency with Americans' foreign policy for many decades until very recently. There's probably more likelihood for America to work with international institutions, multilateral agencies, and other countries. And to the extent America resumes its leadership in international institutions, international agreements, among different nations, I think we would expect a more stable world, which is good for investments.
So what are you seeing now then, in Greater China in terms of sentiment, recovery, the opportunities? And second question to that is, what does it mean for the rest of Asia once that is stable?
I have not visited China for a whole year by now. Last time I was out of Hong Kong, I was in America, I was in India, but I have not stepped into China mainland for a whole year because of the pandemic. And therefore, I'm not familiar with the sentiment over there. But I think that in the first quarter of this year, the sentiment was very weak, and the credibility of the government took a severe beating because of the pandemic, because of the lockdown. because of almost the panic among the populace with regard to the virus. And GDP dropped 6.8% in the first quarter compared with the same period of last year. But I suppose the severe lockdown procedures and process were quite successful. So by second quarter, the lockdown was lifted, the economy started to recover. In the second quarter, the Chinese economy went up, GDP went up 3.2%. And that is quite remarkable because the rest of the world went into a tailspin with regard to economic performance, into a recession. Americans' GDP dropped by more than 9%. In the third quarter, China's GDP went up 4.9% over the same period of last year. And we can expect the last quarter to continue to recover. That is, the economy will continue to recover, probably to a tune of 6%. So it seems that the Chinese economy has recovered to a pre-pandemic level. And if you look at the exports, it went up in July, August, September, October by 7.2%, 9.5%, 9.9%, and 11.4% respectively, month after month over the same period of last year, indicating that the Chinese economy is indeed recovering very strongly. So I think this year in Asia, maybe worldwide, there are only two countries registering positive growth. And one is China, the other is possibly Vietnam, which has done pretty well. The rest of the world, almost every country is in a recession and probably will take a year for the United States, for example, to recover to the same level of 2019. So when we make the investments around, we take into account of all these macroeconomic conditions, including exchange rates, and we'll have to bear in mind the disparity in economic performance across the globe.
So can we expect more PAG deals in China to come?
In China and the rest of the Asia, in fact, we're making an effort to invest in other parts of Asia than China, just to be more balanced in our portfolio. We are making an effort to strengthen our team in Japan, in Korea, in India, in Australia, and in Singapore.
Okay. But what about these headlines that we're seeing about defaults by Chinese state-owned enterprises recently? I mean, how should we be looking at them? What are the implications?
I personally don't pay too much attention on troubles that this company or that company get into, or this bank or that bank get into, because in the market economy, it happens from time to time. What I focus on, what I pay attention to is systemic risks, whether or not there's a crisis, whether or not there's a recession, whether or not there's systemic risk with the banking system. So I think by and large, the Chinese economy is healthy. The financial system is healthy and resilient. Doesn't really matter if there are a few defaults here and there, which probably would help impose some discipline to the marketplace. Not everything is good. You have to be very careful in that market and in other markets. But by and large, I think there's no visible systemic risk that I can see in China or in the rest of Asia.
Right. But coming off the back of that, though, in your view, what are the two or three most serious risks then facing the global economy, if it's not a debt crisis?
Well, I don't know if there's a preset list of risks, but obviously at this moment, everybody is dealing with the pandemic, right? Before the pandemic is brought under control, then the economy cannot fully recover. The opening of the economy cannot be fully implemented. So it is imperative for countries to deal with this crisis. And I think it is very encouraging that a number of companies have come up with vaccines which are nearing phase 3 clinical trials, that is nearing the market. And I hope by the middle of next year, much of the world is vaccinated, and therefore we get out of this pandemic. So I think that's the risk that we look at. Before that happens, I think it's hard to imagine that the economy, especially American European economy, will recover very strongly. China is very different. China has largely eliminated this virus, other than very isolated cases here and there. By and large, the nation is free from the virus, and therefore travel is free, the economy is fully on recovery. But elsewhere in Asia, we still see the major effect of this pandemic. So we need to think about how long it will take and what preparation that you need to make as the owner of a business if the pandemic lasts longer than you expect. In connection with it, of course, is debt. Because in the pandemic, in the lockdown, cash flow is curtailed, your ability to service the debt is limited. So governments this year worldwide have done a lot to help enterprises and consumers. The question is whether or not it is enough to pull the economy and pull consumers through this crisis. You see, there's a debate in the United States, even between the Treasury and the Fed, about what credit facilities should be used or should be withdrawn. I think that debate itself can mean some risk to the marketplace. The third thing is, even though the real economy has been struggling this year, as we see worldwide, stock market has been rising so fast, so unstoppable. And that is also worrisome, because you know there has to be a limit. There has to be a relationship between the public stock market and the real economy. So if something happens in the stock market, of course, that's not going to bode well for the economic recovery.
Yeah, I mean, we were just going to ask you also that based on how the public markets have been rallying, like you just said, valuations have really continued to go up, and at the same time, we've seen larger and larger funds that are being raised, and asset sizes are also getting larger, and competition is getting keener. And so, I mean, how do you see this playing out in the current scenario? Do you expect more global investors deploying more and more capital to Asia, and what does that mean for funds such as yourself?
There's no question about that. There's a glut of capital in the world today, and that is why asset prices are so inflated, especially in the public market. Asia, whether it's public market or private market, has underperformed Western markets. And you see good investment opportunities in Asia. And that is why capital has been flowing into Asia. This is a world where there's a glut of capital, but there's a dearth of good investment opportunities, which will generate very good returns. I think anywhere you will find good investment opportunities, but you really have to look. And Asia certainly offers its fair share of good investment opportunities, especially for those who are familiar with the market.
Yes, but in terms of impact on PE deals as yourself, then I mean, if you really have to look.
Yes, you always have to look. And in the crisis, you have to look. In normal times, you will have to look. I think Asia, by and large, maybe with the exception of Japan, is a low trust society in comparison with America and with Europe. What that means is that trust becomes very important. Reputation becomes very important. In a low trust society, reputation is a signal of your quality. It's just like people buying luxury products. The brand will give you the comfort that the quality is very good. So for those PE firms which have been successful in Asia, which has had a track record for many years, which has had experience, which has built a brand name for themselves, and those PE firms are likely to do much better than, say, newcomers or those who have not established a name for themselves. So as capital flows into Asia, my advice to LPs or our limited partners is that you really have to look for those GPs who are time tested and weather tested, and who have established a reputation and brand name.
Oh, thank you. On that note, that's all the time we have this afternoon. Thank you again to Mr. Weijian Shan, Chairman and CEO of PAG. Thank you for taking the time.
Thank you very much indeed.